Today, we're going to cut through the noise on a really interesting stock move in enterprise software. We're talking about UiPath. Ticker is PATH.
Yep.
For anyone watching, they've had this just incredible run. I mean, from the low $12 range all the way up near 18.
A huge surge.
But the last few days, things have cooled off. The stock dropped down to 1632. And, normally a 3% drop after a big rally like that, it makes you worry. But the financial analysis report we're digging into today frames this completely differently.
It does. It frames it not as a failure, but as possibly the perfect entry point, a consolidation before the next big move up.
Okay, so that's our mission today. We need to synthesize this. We're going to move way beyond just looking at the chart lines.
Exactly. The core argument in this report is that the whole investment thesis for UiPath has been, rewritten. And it's because of these huge fundamental business changes.
So we're going to unpack the three big reasons why this $16 level is so significant.
3 reasons: financial, technological, and valuation-based. And it all kind of centers around this pivot to something called agentic AI.
Okay, let's unpack this.
Yeah.
Starting with the immediate chart action. Because when you see a drop, the first question is always, is the party over?
Right. Is the rally dead?
The stock dropped 56 cents to 1632, landing it right near a really critical support line. It feels dramatic, after such a fast climb.
It does.
But the report uses this term, healthy retracement. So how do we explain why that's healthy and not, a big red warning sign?
Yeah, it's really important to understand the mechanics of the market after a move like that, a parabolic move.
Okay.
When a stock goes from $12 to nearly $18, that run is just full of short-term traders, early investors.
The fast money.
The fast money, exactly. And when they see the stock start to stall out a bit, they do what's called profit taking. They lock in their gains.
And that selling is what pushes the price down.
It's just natural selling pressure. It causes the stock to pull back. It's a standard pattern. Consolidation.
So it's not the runner collapsing. It's more like the runner taking a strategic pause at a water station.
That's a great way to put it. It lets the institutional money catch up and sort of solidify the floor under the stock.
And the analysts in this report are laser focused on one number.
Oh, yeah. $16. That is the critical support zone. It's the absolute line in the sand.
Why that number specifically?
It's a technical pivot point, but it's also psychological. It's where a lot of big institutional buy orders are often placed.
Yeah.
It's where conviction really gets tested.
So the thesis is, as long as PATH holds above 16.
The report suggests the overall bullish trend is completely 100% intact. This is just shaking out the weak hands and resetting for the next move higher.
Okay, so that makes the technical case very clear. But charts don't mean anything if the business itself is flawed. So let's get to the foundation. The report moves pretty quickly to the long-term investment case, and this brings us to reason number 1. It tackles the biggest complaint bears have always had about UiPath.
And that complaint was, it's pretty simple. UiPath was built on this idea of growth at all costs.
Right.
I mean, they were the undisputed leader in their space for robotic process automation, or RPA, but they were just constantly burning cash.
Which was fine a few years ago in a zero interest rate world.
But not today. That narrative always, it kept a lid on their valuation.
And this analysis report is, it's really blunt about it. It says that growth at all costs story is now functionally dead.
Dead, yeah.
So what's the evidence? What did the company do to earn that kind of re-rating from analysts?
They pulled off the ultimate pivot, financial maturity. In their Q3 fiscal 2026 report, they posted their first ever GAAP profitable quarter.
First step.
Ever. And this is so much more than just hitting a target. This is like a signal to the entire market that they've graduated. They're not a speculative startup anymore. They're playing in the league of sustainable, blue chip enterprise tech.
Let's put some numbers on that because they're pretty impressive.
Absolutely. The company reported $13 million in GAAP operating income for the quarter.
So not just a penny of profit, a real number.
A real number. And that $13 million proves their business model can actually scale sustainably. It's not just about growing revenue, but managing the costs.
And there was another number in there about their balance sheet.
A huge one. This profitability comes alongside an incredibly strong balance sheet. They are sitting on a cash pile of $1.52 billion.
Wow, $1.52 billion. That's a war chest. But let's connect this back for everyone listening. Why does hitting GAAP profitability right now matter so much?
If you connect it to the bigger economic picture, it's all about risk. We are not in that zero interest rate world of 2021 anymore.
Right, capital is expensive.
Capital is expensive and investors are risk averse. So companies that need constant cash injections just to grow are getting hammered. By hitting profitability, UiPath just removes that entire systemic risk from their story.
And that cash pile gives them options, I imagine.
A huge strategic advantage. It means they don't have to build everything from scratch. They have the firepower to go out and acquire smaller, cutting-edge AI startups if they want to.
Instantly integrating new tech.
Exactly. So this combination profitability plus that balance sheet, it just re-rates the whole company. It makes it a much more stable investment, especially if you're worried about a recession.
So that's a total redefinition of their financial DNA. And their technological DNA is shifting just as much, which is reason number 2. Agentic automation is the real catalyst. And this is where I think it gets really interesting for anyone following the AI space.
Yeah, this is the core of the news story. While everyone was focused on the consumer side, ChatGPT and all that, UiPath was quietly executing this massive internal pivot. They realized that their bread and butter traditional RPA was kind of hitting a ceiling.
And RPA was what? Basically automating simple back office stuff.
Fantastic for that. Simple, repeatable, rules-based tasks. Think of it like a digital accountant just following a very rigid checklist. Copy this, paste that.
So we're talking about reading an invoice, pulling out the numbers, and pasting it into another system. Simple if-then logic.
Precisely.
So what's so different about this agentic AI?
It's the shift from robotic process execution to autonomous judgment. Autonomous decision-making.
Okay, give me an analogy for that.
Okay, think of traditional RPA as a calculator. It does exactly what you program it to do, and if it sees something it doesn't recognize, it just freezes and needs a human.
Right.
Agentic AI is like a highly skilled analyst. It understands the end goal, it gathers data from all over the place, it makes complex judgment calls, and it solves multi-step problems without needing step-by-step instructions.
So that's moving from automating data entry to almost automating management functions.
Exactly. These autonomous agents can handle incredibly complex workflows. Like, it could read a customer service transcript, decide the best follow-up, is it a refund, an email, an escalation, based on sentiment, and then execute all those steps itself.
That's a huge leap in value.
It's a monumental leap. And the report points to their strategic partnerships as proof this isn't just, marketing fluff.
Right, this isn't just a buzzword.
Not at all. The proof is the integrations with the biggest names out there. OpenAI, Google Gemini, and NVIDIA.
So they're not trying to build the foundational AI models themselves.
No, why would they? They're integrating the world's most powerful AI models directly into their workflow platform. That lets their robots do high-level things like draft legal summaries or synthesize market reports.
And the NVIDIA part.
That's about hardware. They're optimizing their agents to run on the best possible chips for AI, ensuring top performance for their big enterprise clients. It's a very smart strategy.
And what this all does, strategically, is it unlocks what every growth investor wants to see.
A massive expansion of their total addressable market, their TAM.
Right.
Before, the market was mostly back office stuff. HR, finance, supply chain. With agentic AI, they're now competing in the front office. High-value decision-making, customer interactions, sales optimization.
Which lets them change how they charge for their product.
That's the other huge piece. They can switch from pricing based on time saved by a bot to a value-based model where they charge based on the quality of the decision the AI agent makes. That just exponentially increases their revenue ceiling per customer.
And that sets up our third and final reason perfectly. The valuation argument.
Yes.
Because despite this massive leap in financials and technology, the stock is still being priced like the old UiPath.
This is really the core of the opportunity that the report highlights. You have to look at the EV to revenue multiple, enterprise value to revenue. It's how the market prices these kinds of growth companies.
Okay, and where is UiPath trading at?
Right now, it's at roughly 4.7 times EV to revenue.
And for anyone listening who doesn't track these metrics daily, what does 4.7 mean? How does that stack up?
It means it's cheap. It means the market is giving them a pretty big discount. When you look at other true AI software names companies, the market has already accepted as AI leaders. They're trading in the 10 to 15 times multiple range.
Wow, so more than double.
More than double. We're talking about companies with similar growth rates commanding a much higher valuation purely based on investor perception.
So the argument is that the market is still pricing Path like a legacy RPA player, not the agentic AI powerhouse it's becoming.
That's it in a nutshell. If the market just starts to value UiPath the way it values its AI peers, the stock price could double without the company even having to increase its current sales.
That's the whole thesis right there, the multiple expansion.
It's a potential catch-up trade. The report sees the current price as a big disconnect between the company's new fundamentals and its old market perception.
Okay, I have to play devil's advocate here for a second.
Please do.
If the story is this good gap profitable, tons of cash, leading this AI shift, why hasn't the market already closed that gap? What's the catalyst that investors are waiting for?
That's an excellent question. And the answer is proof. The market is waiting for concrete proof that agentic AI is actually generating significant new revenue.
So it's a show me the money situation.
Exactly. We have the technology, we have the partnerships, but the numbers showing that big TAM expansion, they need to start appearing in the quarterly reports. Analysts are adjusting their models now, expecting that revenue to really accelerate through 2026.
And when those big ticket agentic AI deals start hitting the top line.
That's the moment the 10 times multiple becomes very, very real. And that's why the report details these medium-term price targets of, $20 to $22. That's achievable if the market just decides to re-rate them.
That paints a really compelling medium-term picture. But for someone watching the ticker right now, this week, what are the immediate action items from the report?
Okay, so there are 3 key things to monitor. First, and most immediate, is the $16 support test on the open. You have to see if buyers step in with conviction at that level.
And the volume of trading tells you how much conviction is there.
It does. That's the second point. Volume analysis. The report says to look for lower volume on red days, like this recent dip. That confirms it's just profit-taking, not a panic.
And on the flip side,
You want to see high volume on the green days, on the bounces. That signals the big institutions are stepping in to defend that $16 level. It validates the floor.
and the third point is watching the people who actually drive these re-ratings.
Yes, watch for analyst upgrades. Keep an eye out for firms upgrading their ratings or, more importantly, raising their price targets. As they finish their 2026 models with this new agentic AI revenue factored in, their buy calls can be the catalyst the rest of the market needs.
So the report really lays out 2 paths based on your own risk tolerance.
Right. An aggressive entry might be right here, around 1630, anticipating that the support will hold. A more conservative entry would be to wait for a confirmed bounce off 16.
With the initial target at 1850 and that longer-term re-rating target at 22.
It all comes back to managing your risk around that $16 line in the sand. That's the level that defines the short-term story.
Okay, so what does this all mean? The report concludes that the foundation for UiPath has been completely redefined. They're past the growth at all costs phase, they're GAAP profitable, they're flush with cash, and they're trying to lead the highest growth part of enterprise software, autonomous agentic AI.
So this pullback, in that context, is seen as the market just momentarily forgetting the new story. And that's why it's framed as an opportunity.
It's a moment where technical noise is maybe obscuring the fundamental signal.
That's a perfect way to say it. And this shift, from simple RPA to whole agentic AI, it means UiPath is betting its entire future on the autonomous decision-making capability of its platform.
Okay, so let's leave our listener with one final provocative thought to chew on.
Here it is. The real question to explore isn't whether the technology works. The partnerships with NVIDIA and OpenAI, they kind of confirm the tech is real.
Right.
The real question is this. How rapidly will traditional, often risk-averse enterprises actually trust and adopt AI agents that are capable of front-office decision-making?
The trust factor. Handing over cognitive tasks to an AI, that's the ultimate variable.
It is. Because that adoption timeline, that dictates the speed of the revenue acceleration. That's the factor that will determine if the market gives them that aggressive 10 or 15 times multiple quickly, or if that journey takes a couple of years longer than the optimists hope. That's the real unknown.
An excellent thought to end on. Thanks for joining us. We'll see you next time.